Howdy, Jacob here. Today we're looking at Donaldson Company in the machinery industry, 8.45 billion market cap on slightly higher enterprise value. They manufacture and sell filtration system and replacement parts worldwide. Headquartered in Bloomington, Minnesota, right by where I grew up. Founded in 1915. Growth of revenue is not substantial. Over the last 10 years, you're probably looking at 2 to 4%, 2 to 5% annual compound growth rate. And their margins are okay, 30 to 35% on the gross side, 10 to 15% on the operating side. I do like that operating margin. That is pretty good. So it looks like majority of expense are coming from cost of goods sold. And they do pay a dividend, and it doesn't look to be substantial in relation to their earnings per share. So they are leaving a bit of capital available for reinvestment, which to me sounds fantastic with these historical return on invested capital between 15 and 20% and return on asset of 12 to 15%. Very great, very grand. Income statement shows R&D up a little bit, about 50%, and it's still inconsequential in relation to their revenue. Very small, but I mean, maybe 2 to 3%. But even still, that's taking money away from today to hopefully make them more efficient tomorrow. And their shares, they are repurchasing shares down from 138 shares outstanding to 121 million. And their balance sheet shows, did I say million? That sounds like a lot. It could be, it's definitely not million, but their shares are down quite a bit from 10 years ago. Their balance sheet has 233 million cash on hand, 53 million short-term debt, 483 million long-term debt. Not a whole lot of net debt here. Let's see, 400 million is 1 year free cash flow. So that balance sheet, not concerned about at all. Takes 1 good year of free cash flow to pay off that long-term debt. That's fine. It's not bad to have a little bit of debt. It could give you opportunities. That's the reason people go into debt. And when you have a lot, you create a lot of cash flow and you do it consistently as a business. I don't think it's unreasonable to have, even 2 to 3 times your 5-year average free cash flow. So for me, their lowest free cash flow the last 10 years appears to be still over 100 million. And so they definitely produce a good amount of free cash flow. Even on that basis, it is 4 times that. And that's excluding the amount of cash they have on hand. And so if we look at capital allocation, we look at a pretty decent net acquisition here and here, but majority of that money is going towards, consistently at least, going towards a dividend. That dividend pays out 1.5% yield, pretty much in line with the market average, and then a little bit more to share repurchases. So on a percent basis, you're probably looking at maybe 20 to 25% to dividends, about 30% share repurchases, a little bit to debt reduction, and then a little bit to acquisition. So they do have historically high rates of return on invested capital. They're not necessarily reinvesting a whole lot, which you can see from their capex being roughly flat and them just making acquisitions. But hopefully they're very strategic with those acquisitions and they're able to get a return on them that's advantageous to you. I do like a lot of these things: increasing gross margin, increasing operating margin, meaning bottom line's increasing more than top line. Buying back some shares, earnings per share is over double what it was 10 years ago, with revenue up maybe 50%. So a lot of things looking really good here, but let's look at it from a price perspective, because that's to me the most important thing to get the return you're looking for on an investment basis. Taking away the company being as great or bad as it is, what do you think they're going to produce in cash, and what type of return are you looking for here? So for me, like always, looking for a 15% return. Revenue growth, I think you'll probably be sticking with a 4% revenue, maybe 5%, but I'll stick with 4, saying that they're able to go 2 to 3% organically, very likely. And then if they do allocate 10 to 20% of capital allocation to acquisitions, that could easily get them to 4% a year for the next 7 years. Margins, let's do a little bit of a range here. It has been going up, but I'm just going to stick with the more recent figures of 10, 11%. Share repurchases, 1% for them is about 85 million. It's about 100 million to offset stock-based compensation. So 1.5% for them is about 140, 150 million. I think I'm good doing 1.5%, 150 to 400. You're looking at 30 to 40% of free cash going towards share repurchases. The dividend, historically, they have increased it. I don't usually like increasing dividends very much, so I'll give them a sub revenue growth dividend increase, saying that 2% a year, their capital allocate or their percentage of payout going toward dividends will go down slightly over the 7-year period, leaving more money available for hopefully acquisitions that make sense, and then reinvesting to get those historical huge rates of return, and then give a little bit of money for debt repurchase, I guess. But I mean, they don't have much debt, so I'm not assuming any debt repurchase here since they're pretty solid with a 1 year of free cash flow for debt. And then the biggest item here, your terminal PE. See, great returns on invested capital, but again, they don't really reinvest that much. And so for me, a company that just pays out money to the shareholders with a high return on invested capital doesn't necessarily deserve that premium. So I'll give them market average here. And we're saying it needs to fall roughly in half, maybe a little bit more to get the return I'm looking for here. So like I said, I love the numbers here. Maybe I'm being a little bit conservative on some of these figures, but it's definitely going to have to fall quite a bit more for me to be more attracted to the price of the business and as an investment and not from the company perspective of just thinking the company's great from looking at the numbers. I hope you enjoy this video and have a great rest of your day. Thanks.